Let's talk about adding somebody as a joint tenant to your house deed in order to pass your home to them at death. I'm on a mission to explain to people the dangers associated with this. Here's how it comes up. You have a house. Perhaps you have a child. You'd like your child to inherit your house. You think, if I add them as a joint tenant with right of survivorship to my house deed, when I die, immediately they'll own the house, because that's what happens when you have a joint tenant. You own a house in joint tenancy, one tenant dies, immediately the other tenant owns the entire home. The problem with doing this is that there are tax consequences associated with passing your house while you're alive that do not come into play if you pass property at death. This has to do with the stepped-up basis. So when you buy a house, let's say you bought a house 20 years ago and you bought it for $100,000. And today it's worth $1 million. It's not unusual in California for houses to appreciate that much. Your basis in the house is $100,000. And if you went to sell it today for $1 million and didn't buy another home, you would be subject to capital gains taxes on $900,000. Capital gains taxes right now are 40%. So you would owe 40% of $900,000. Now, if you give somebody your house while you're alive, they take the portion that you give them at your cost basis. So while you're alive, you give somebody your home that you have a base of $100,000 in, they take the home at $100,000. If they then want to go sell it, they sell it for $1 million because that's what it's worth today. They're going to owe capital gains taxes on $900,000. If you leave the same house to them at death, they take it with a cost basis of $1 million. And then if they go to sell the home, they sell it for $1 million. There's no capital gains taxes because there's no capital gains, because their basis is the same that they sold it for. So when you add somebody to your house as a joint tenant on your house deed, if you're just adding one person and you're the sole owner of the home, well, then you're splitting it with them, essentially 50-50. You're giving them half of the ownership interest in the home. And when you pass away, that half ownership interest that you gave them, it's going to be presumed that they took it at your cost basis of what you bought the home for. So when you pass away, half of the home is going to come to them at the new cost basis because it's passing to them at your death, but half of the home is coming to them at your initial cost basis. And the difference between that and what the home sells for, there will be capital gains taxes associated with that difference. So it's kind of complicated to think about, but these are the reasons why it's really important to at least understand that you are creating a potential capital gains tax issue for the person you're giving your house to while you're alive. If you have any questions, would like to talk about this further, I'm happy to chat.